this has been very much the year of waiting to see if mega cap technology could rebound. It did so in a very big way. But is that the only market narrative that we care about right now? Do we need to see this broadening out happen in order for the rest of the market to feel like it can be, yes, in a good position?
Yeah, I mean, I think that there's a place in the portfolio for technology for sure. But I do think that it would be healthier if this broadening that we have been seeing over the last couple of weeks, if it continues. I think it will, Dom, and I think a lot of that has to do with the fact that the economy is hanging in better than most people expected, which is leading to better in that expected earnings, and then you see this broadening out. I'm really particularly encouraged today to see energy hold up even after yesterday, because energy had a great day yesterday. So we've now started to see manufacturing do a little bit better, industrials do a little bit better, especially if you look at kind of onshoring names like an Ingersoll Rand, which had a 12% total revenue growth and 5% organic growth. Aerospace, look at GE and Boeing, both raising free cash flow guidance. So the manufacturing side of the economy is doing well. And I think financials should also pick up the slack as well, given that they actually had 19% earnings growth in when most of the banks did anyway, when they reported the second quarter earnings, and the stocks are really cheap. So I hope that the broadening continues, Dom. My portfolio is betting on that, but I do still think there's a place in the portfolio for technology, clearly.
Okay, Stephanie, you laid out where you think the best catch-up trades are, places like in energy, financials, and in certain parts of the industrial complex. I love the names as well. What is your assumption in terms of macro for how these stock market gains in this catch-up trade can come to fruition? Do you expect a recession? Do you expect this kind of softer landing scenario? When do we see a pullback? Stephanie?
We can probably tread water, Dom, in August and September. We know seasonally these aren't great months ahead of us, and we've had a nice run. But if I look at the economic data, particularly the jobs numbers, right? And we get a big one in a couple of hours. But if I look at the jobs data, it's actually hanging in remarkably well, and that's helping prop up the consumer. I mentioned manufacturing and the themes that are doing well there. I think PMIs are actually bottoming. And when you look at GDP, well, we did 2% GDP in the first quarter, 2.4% in the second quarter, and now the Atlanta Fed GDP now is at 3.9%. That number is going to probably come down, but no one was looking for an acceleration in GDP starting at the beginning of the year. So I think we can see like a 2%, 2.5% kind of GDP for the rest of the year. And that's very healthy. That's good for earnings. And so if we do get this kind of choppy sideways action in August and September, look for opportunities. I'll tell you right now, one opportunity this morning is Fortinet. Cybersecurity is on fire, but this stock missed and they lowered. I think a lot of it had to do with tough comparisons and, yeah, some chop in the enterprise market, but the stock's down 17%. There is an opportunity right there.
And Stephanie, just a few moments before we let you go, your word of the day, I need to know it.
Earnings. So we just talked about earnings, right? For companies, 78% of the S&P 500 companies have reported beating by about 75% about beating expectations. But also, of course, we get the non-farm payroll numbers, Dom, this morning, and average hourly earnings are going to be top of mind. I think the number can come in close to 4%, down from 4.4 last month.